The Great Crash of 1929 did not begin in October. It began 731 days earlier when the most important man in American finance died, and the credit that fueled the boom began a slow, methodical withdrawal that no one could stop. Resonance. We explain history through economics and finance. The story of 1929 begins with a financial machine that seemed perfectly designed. This was the call loan system of Wall Street. It worked with elegant simplicity. Banks lent money to stockbrokers. These were call loans, repayable on demand. Brokers then lent this money to speculators. They bought stocks on margin. The collateral was the stocks themselves. This created a self-reinforcing cycle. Rising stock prices meant more collateral value. More collateral meant more borrowing capacity. More borrowing meant more buying power. This pushed prices higher still. The Federal Reserve Bank of New York managed this system. Its governor was Benjamin Strong. He understood the mechanics intimately. From 1922 to 1928, Strong maintained stability. He used open market operations. He adjusted discount rates carefully. He coordinated with European central banks. The gold standard provided external discipline. America had to maintain gold convertibility. This limited how much credit could expand, but within those limits the system hummed. Our loan rates typically range from 3 to 5%. These were secured loans with stock collateral. They seemed perfectly safe. Banks earned steady returns. Brokers earned the spread. Speculators accessed cheap leverage. Everyone appeared to win. The institutional friction was minimal. New York banks dominated the call loan market. They had direct relationships with brokers. The New York Stock Exchange provided transparency. Prices were published daily. Collateral values were marked to market. Margin requirements were around 10%. This meant a speculator needed only $10 of their own money. They could borrow $90 to buy $100 of stock. This leverage ratio of 10 to 1 fueled the boom. The human consequence was predictable. A generation of Americans discovered stock speculation. They read about neighbors making fortunes. They heard stories of secretaries retiring rich. The psychology shifted from saving to speculation. Money flowed from savings accounts to brokerage accounts. This was not reckless gambling to them. It was participating in a new economic era. Radio, automobiles, and electricity promised endless growth. The stock market seemed to reflect this reality. Prices had risen for years. Corrections were brief and shallow. Each dip was a buying opportunity. The system appeared self-correcting. Strong's Federal Reserve stood ready. It could provide liquidity if needed. It had done so in 1924. It had done so again in 1927. Each intervention reinforced confidence. The machine seemed to have a permanent operator, but machines require maintenance, and operators can be replaced. This would become the critical vulnerability. The call loan system depended on continuous credit flow. It needed banks willing to lend. It needed brokers willing to borrow. It needed speculators willing to buy. Most importantly, it needed someone managing the valves. That someone was Benjamin Strong. His death would change everything, but that story comes later. First, we must understand why the system made sense, why rational people believed it could continue. The answer lies in the numbers. From 1921 to 1928, industrial production doubled. Corporate profits tripled, stock prices quadrupled, the economy grew at 5% annually, unemployment stayed below 5%. Inflation was virtually zero. These were not speculative fantasies, they were measurable economic facts. The call loan machine appeared to be financing real growth, was channeling savings into productive investment. At least, that was the theory. The reality was more complex. Much of the credit went into existing stocks. It financed trading, not building factories. But this distinction was overlooked. The machine worked, that was all that mattered until it didn't. The strain emerges. Moving on, we reach the turning point. October 16, 1928. Benjamin Strong died of tuberculosis. He was 55 years old. His death created an institutional vacuum. The Federal Reserve Bank of New York lost its dominant voice. Power shifted to Washington. The Federal Reserve Board had different priorities. It was concerned about stock market speculation. It wanted to curb the use of credit for gambling, but it lacked Strong's operational experience. This created immediate friction. The mechanics of the strain were technical. Gold began flowing out of the United States. Europe was rebuilding after World War I. It needed capital. Higher interest rates there attracted gold. The Federal Reserve had to respond. Under the gold standard, outflows required contraction. The Fed raised its discount rate. This was the rate at which banks could borrow from it. The increase was from 3.5% to 4%, then to 4.5%, then to 5%. Each increase made call loans more expensive, but the effect was not immediate. Speculators kept borrowing. Stock prices kept rising. The institutional friction increased. New York banks faced conflicting signals. The New York Fed wanted stability. Washington wanted restraint. Banks reduced their broker loans cautiously. They shifted funds to other investments. But the call loan market found new lenders. Corporations entered the space. They had surplus cash from profits. They could earn higher returns lending to brokers. This was the beginning of shadow credit. Non-bank lenders filled the gap. The human consequence was subtle at first. Brokers noticed banks becoming reluctant. They had to shop around for funds. Call loan rates became more volatile. They spiked to 6%, then 7%. These increases were absorbed. Speculators kept buying. The psychology was still bullish, but beneath the surface, pressure accumulated. The Federal Reserve implemented direct pressure. This was a policy of moral suasion. Officials visited banks personally. They urged them to reduce speculative lending. Some banks complied. Others found ways around the guidance. The credit contraction began slowly. Total broker loans peaked in early 1929. They reached $8.5 billion. This was enormous for the time. The entire money supply was about $45 billion. Broker loans represented nearly 20%. Strain was becoming visible. The New York Times began reporting on credit conditions. Articles discussed the call loan market daily. Rates were front-page news. Financial pages showed detention. Banks were lending less. Corporations were lending more. The composition of credit was changing. This mattered because corporations were flighty. They could withdraw funds quickly. Banks had longer-term relationships. The institutional stability was eroding. The Federal Reserve faced a dilemma. It wanted to curb speculation, but it didn't want to cause a crash. It tried to thread the needle. It raised rates enough to slow things, but not enough to stop them. This was the fatal miscalculation. Gradual tightening doesn't work with leverage. When everyone is borrowing, small increases compound. A 1% rate increase seems minor, but on 10-to-1 leverage, it's significant. It reduces the margin of safety. It increases the risk of margin calls. The mathematics were working against stability. Each rate hike made the system more fragile, yet prices kept rising. The disconnect grew wider. By summer 1929, the strain was evident. Call loan rates hit 8%, then 9%, then 10%. These were warning signs, but they were ignored. Quaddies, the human psychology had shifted. People believed the market could only go up. They dismissed negative signals. They rationalized high rates as temporary. They pointed to strong corporate earnings. They talked about new technologies. They believed in perpetual prosperity. This belief would be tested. The credit withdrawal was accelerating. Banks were reducing exposure systematically. They were not panicking. They were being prudent. But collective prudence can be destructive. When everyone reduces risk simultaneously, markets fall. This was the paradox of safety. Each bank acting responsibly created systemic risk. The strain was now structural. The call loan machine was losing its fuel. Credit was becoming scarce. Rates were becoming prohibitive. The boom was living on borrowed time, and time was running out. Adaptations and workarounds. To understand this better, we must examine the adaptations. When banks retreated, others stepped in. This is the story of financial innovation under pressure. Corporations became the new lenders. They had cash from record profits. The 1920s were boom years. Industrial companies generated huge surpluses. They needed places to park this money. The call loan market offered attractive returns. 6 to 8% was better than bank deposits. So they lent directly to brokers. This was the shadow banking of its day. The mechanics were straightforward. A corporation would deposit funds with a broker. The broker would pay interest daily. The corporation could withdraw on demand. This mimicked the call loan structure, but without bank intermediation. The institutional friction increased immediately. Corporations lacked banking expertise. They didn't understand market dynamics. They were sensitive to rumors. They could panic at the first sign of trouble. Banks had deeper pockets. They had relationships with the Fed. They could access emergency liquidity. Corporations had none of these buffers. The human consequence was increased fragility. Brokers now dealt with hundreds of corporate lenders. Each had different risk tolerance. Each required individual attention. The administrative burden grew. The system became more complex, less transparent, more prone to sudden withdrawals. Meanwhile, the Federal Reserve continued its pressure. It raised margin requirements. Brokers increased the down payment needed from 10% to 20%, then to 30%, then to 40%. By October 1929, margin was 50%. This meant speculators needed $50 of their own money. They could only borrow $50 for $100 of stock. Leverage dropped from 10 to 1 to 2 to 1. This dramatically reduced buying power. The mathematics were brutal. With 50% margin, a 10% price drop triggered a margin call. The speculator had to put up more cash. If they couldn't, the broker sold the stock. This created selling pressure, which caused more price drops, which triggered more margin calls. A vicious cycle was possible. The adaptations created new vulnerabilities. Corporations lending to brokers created concentration risk. Few large corporations held significant positions. If they withdrew, the market would feel it, and they were precisely the type to withdraw first. Corporate treasurers were conservative. Protected company funds. They would not ride out a storm. They would cut and run. This reality was not widely understood. The public saw rising stock prices. They didn't see the credit shifting beneath. The institutional landscape was changing. Banks were reducing exposure. Corporations were increasing exposure. The quality of credit was deteriorating, but the quantity appeared stable. Total broker loans stayed around $8 billion. This masked the underlying deterioration. The Federal Reserve noticed the shift. It grew concerned about corporate lending. It had limited tools to address it. It couldn't regulate corporations directly. It could only pressure banks, which were already retreating. This created a policy gap. The adaptations were outpacing the regulators. Another workaround emerged. Investment trusts became popular. These were early mutual funds. They pooled investor money. They bought stocks on margin. They created additional leverage layers. An investor would buy trust shares. The trust would borrow to buy more stocks. This created double leverage. The system became more opaque. Risk became harder to measure. The human psychology adapted too. Speculators became more sophisticated. They used stop-loss orders. They pyramided their gains. They bought on dips. They believed they could outsmart the market. This confidence was dangerous. It masked the building pressure. The credit contraction was now 7 months old. It had started in early 1929. Slowly, steadily, credit was becoming tighter. Rates were higher. Terms were stricter. Lenders were more nervous. But the market kept climbing. This divergence couldn't last forever. Something had to give. Either credit would ease or prices would fall. The Federal Reserve faced its moment of truth. It could reverse course. It could ease credit to support the market. This would abandon its anti-speculation stance, or it could stay the course. It could continue tightening, but risk causing a crash. It chose the middle path. It did nothing decisive. This was perhaps the worst choice. Uncertainty grew. Lenders became more cautious. The adaptations were running out of road. The workarounds were becoming exhausted. The system needed a resolution. It would get one in October. But first, we must understand the loss of trust. The moment when psychology finally broke, the trust evaporates. Now consider this. Trust in financial systems evaporates slowly, then all at once. Summer 1929 was the slow phase. The psychology began shifting. The evidence was subtle but accumulating. All loan rates became erratic. They would spike to 12%, then drop to 8%. This volatility signaled uncertainty. Lenders were nervous. They demanded higher compensation for risk. The institutional friction became visible. Banks published their broker loan totals weekly. The numbers started declining, not dramatically, but consistently. Month after month, the trend was down from $8.5 billion to $8 billion. Then to $7.5 billion. The credit contraction was measurable. The human consequence was anxiety. Brokers felt the change. They had to work harder for funds. They spent hours on the phone. They negotiated with multiple lenders. Their profit margins compressed. The spread between borrowing and lending rates narrowed. This reduced their incentive to facilitate speculation. Meanwhile, corporate lenders grew nervous. They read the same newspapers. They saw the same trends. They began asking questions. How safe were their loans? What happened if stock prices fell? Could they get their money back quickly? These questions had no good answers. The mechanics of trust erosion followed a pattern. First, lenders reduced new commitments. They stopped increasing their exposure. Then, they began shortening maturities. They demanded daily renewal instead of weekly. Then, they started asking for better collateral. They wanted higher quality stocks. Then they began withdrawing funds quietly. $1 million here, $1 million there. The drip effect accumulated. By September, the outflow was noticeable. The New York Times reported on it regularly. Financial columns discussed credit conditions. Experts debated whether it mattered. Some said it was healthy correction. Others warned of danger. The public remained largely unaware. They saw stock prices hitting new highs. They didn't see the credit draining away. The institutional breakdown accelerated in September. The Bank of England raised its discount rate. It needed to attract gold back to London. This put pressure on the Federal Reserve. It had to raise rates further to protect gold reserves. On September 26, the Bank of England raised to 6.5%. This was a seismic event. It signaled global credit tightening. Money would flow to London, away from New York. The Federal Reserve had to respond. It raised its discount rate to 6%. This was the highest since 1921. The message was clear. Credit would get tighter, much tighter. The human psychology shifted decisively. Corporate treasurers panicked. They began withdrawing funds from brokers. Not all at once, but in growing numbers. The call loan market started seizing up. Brokers couldn't find replacement funds. They had to sell stocks to repay loans. This created the first wave of selling. Prices began declining in early October. The drop was modest at first, 5% here, 3% there, but it was enough to trigger margin calls. Speculators who had bought on thin margins got notices. They needed to put up more cash. Many couldn't. They had exhausted their resources. They had borrowed from friends. They had mortgaged homes. They had no more cash, so brokers sold their stocks. This created more selling pressure. Prices fell further. More margin calls were triggered. A feedback loop began. The trust was now gone. Lenders wanted their money back. They didn't care about collateral values. They wanted liquidity, safety. The institutional response was inadequate. The Federal Reserve watched from the sidelines. It believed the market needed to correct. It didn't understand the leverage involved. It didn't see the domino effect. The human consequence was panic, not the dramatic panic of October 24th, but the quiet panic of lenders withdrawing, the slow motion run on the call loan market. This was the real crash. The October collapse was just the visible manifestation. The credit had already dried up. The trust had already evaporated. System was already broken. October merely revealed the damage, but we're getting ahead of ourselves. First, we must examine the final break, the moment when continuation became impossible. The mathematics of collapse. What happens next? We reach the breaking point. October 1929. The 731-day process culminates. The mathematics become undeniable. Let's examine the mechanics. Call loan rates hit 20%, then 25%, then 30%. These were not market rates. They were panic rates. They signaled complete credit freeze. Lenders would not lend at any price. The institutional friction was total. Banks refused to roll over loans. Corporations demanded immediate repayment. Brokers had nowhere to turn. They had to sell stocks, but there were no buyers, only other forced sellers. This created a liquidity vacuum. Prices gave down. They fell 10% in an hour, then 20%, then 30%. The mathematics of margin calls accelerated. With 50% margin, a 30% drop wiped out the equity. The speculator owed money. Broker had to sell the remaining collateral, but the sale proceeds wouldn't cover the loan. The broker took a loss. This loss reduced the broker's capital, which reduced their ability to borrow, which forced more selling. A death spiral began. The human consequence was devastation. Speculators watched life savings disappear. They received telegrams demanding more cash. They had none. Their stocks were sold at ruinous prices. Their debts remained. Many faced personal bankruptcy. The psychology shifted from greed to fear, from optimism to despair. The institutional response was too late. The New York banks tried to organize support. J.P. Morgan and others pooled funds. They bought stocks to support prices. This worked briefly on October 24th. Prices stabilized for a few hours, but the credit freeze continued. Lenders kept withdrawing. The support was insufficient. The mathematics were overwhelming. Total broker loans had been $8.5 billion. Now they were collapsing. Every withdrawal forced selling. Every sale lowered prices. Every price drop triggered more margin calls. The feedback loop was unstoppable. The Federal Reserve finally acted. It injected liquidity into banks. It encouraged them to lend to brokers. But the psychology had broken. Banks were afraid. They hoarded cash. They didn't trust collateral values. They didn't trust borrowers. They didn't trust each other. The credit mechanism was frozen. The 731-day process reached its conclusion. From the first credit tightening in early 1928, through the death of Benjamin Strong, through the rate hikes, through the corporate lending boom, through the gradual withdrawals to the final panic, every step was logical. Every decision made sense at the time, but collectively, they created catastrophe. The mathematics of leverage ensured this outcome. With 10-to-1 leverage, a 10% price drop wipes out equity. With widespread leverage, small price moves create large forced selling. With interconnected credit, one failure spreads to others. The system was designed to amplify shocks, not absorb them. The break was inevitable once credit began contracting. The timeline was determined by the withdrawal rate. 731 days was how long it took for lenders to lose confidence, for alternatives to be exhausted, for psychology to shift, for mathematics to take over. The crash was not an event, it was a process, a slow-motion unraveling. The October collapse was simply the endpoint, the moment when the numbers no longer worked, when continuation became mathematically impossible. The credit had dried up, the trust was gone, the leverage was unwinding. Nothing could stop it, not bank pools, not Federal Reserve actions, not hopeful speeches. The machine had run out of fuel, and without fuel, it stopped. This is what financial historians mean by liquidity dry up. Not a sudden event, but a gradual process. Slow suffocation of credit. A methodical withdrawal of trust. A mathematical certainty once begun. The Great Crash was 731 days in the making. Every day mattered. Every decision contributed. Every adaptation created new vulnerabilities. The system didn't fail because of one mistake. It failed because of many small choices, each rational in isolation, each catastrophic in combination. This is the lesson of 1929. Not that speculation is bad, but that leverage is dangerous. Not that markets can crash, but that credit can evaporate. Not that greed exists, but that trust is fragile. The mathematics don't lie, they just wait for their moment. Patterns in history. What does this episode reveal about economic systems? The pattern appears elsewhere: the slow credit withdrawal, the adaptation to new lenders, the eventual freeze. This mechanics preceded transitions in 1929 and 2008. The timeline differs. The players change, but the process remains similar. First, credit expands rapidly. Leverage increases. New lenders enter the market. Traditional institutions retreat. Then, strain emerges. A trigger event occurs. Sometimes a death like Benjamin Strong's, sometimes a policy shift, sometimes an external shock. Credit begins contracting slowly. Lenders become cautious. They reduce exposure gradually. The system adapts. New workarounds emerge. Shadow banking grows. Complexity increases, transparency decreases. Then trust erodes. Psychology shifts from greed to fear. Withdrawals accelerate. Liquidity disappears. Break occurs. Mathematics takes over. Leverage unwinds. Prices collapse. The pattern is recognizable across centuries. The South Sea Bubble involved credit expansion. The Panic of 1873 involved railroad speculation. The Great Depression involved debt deflation. Each followed similar mechanics. The institutional lesson is clear. Credit systems are fragile. They depend on continuous trust. Once trust begins eroding, reversal is difficult. The human psychology amplifies the process. Greed during expansion. Fear during contraction. Rational individuals create irrational outcomes. The historical insight is not about blaming anyone. It's about understanding systems, how they work, how they fail, how they can be made more resilient. The 731-day collapse teaches us about time. Financial disasters are not sudden. They develop over years. Warning signs appear early. They are often ignored until it's too late. The Federal Reserve learned from 1929. It created new tools: deposit insurance, lender of last resort powers, margin regulations. These helped for decades, but the pattern reappeared in 2008 with different instruments: mortgage-backed securities instead of call loans, investment banks instead of corporations, but the same process: credit expansion, new lenders, complexity growth, trust erosion, liquidity freeze. The mathematics were identical. Leverage unwound, prices collapsed. The timeline was different, but the mechanics were the same. This suggests a fundamental truth about finance. Credit systems have inherent vulnerabilities. They can be managed, but not eliminated. The key is recognizing the pattern early, monitoring credit growth, watching for new lenders, measuring leverage, assessing trust. These are the warning signs. They appeared in 1928. They appeared in 2005. They will appear again, not as predictions, but as historical patterns. 731-day collapse was not unique. It was an example of a recurring process, one that financial systems seem destined to repeat unless we learn the lessons. Not just the facts, but the mechanics. The the slow withdrawal of credit, the adaptation to new lenders, the erosion of trust, the mathematical inevitability. These are the true lessons of 1929. They remain relevant today, not for predicting the future, but for understanding the past, and through that understanding, perhaps building more resilient systems. That is the hope of financial history. That by studying how systems failed, we can learn how to make them stronger. The 731-day collapse offers that opportunity. A detailed case study in credit mechanics, a warning about leverage and trust, a reminder that financial disasters are processes, not events, and that understanding the process is the first step toward prevention.
Subscribe to the channel. Give this video a like, share it out, and drop your questions or ideas in the comments. Until our next adventure.